Good morning, ladies and gentlemen. It's always a humbling experience when you look at the program for an event and the person immediately preceding you is described as delivering a speech that will be inspirational. I can't promise to reach quite the heights that Francesca did, but I'm going to try and give you some flavour of how, from the vantage point that I have at Invest Europe, how it is that private equity looks today in 2019 and what some of the challenges might be over the months and years that will follow. But firstly, let me thank Tarek for his words of introduction and thank everybody at Politan Partners, not only for giving me the opportunity to speak to you today, but for all of the work that the firm does on behalf of the private equity industry across Europe. For all of the time that I've been at Invest Europe, and indeed for, I know, many years prior to that, this firm has been one that has taken the collective interest seriously and has devoted a lot of time and effort towards supporting the work of Invest Europe and of the BVK. So on behalf of the whole Invest Europe membership, thank you for all of that support. The title that I was given for my presentation this morning was Thriving in a Time of Change. And I think if we look at the state of the industry right now, I think thriving is a very good way of describing it. We've had two successive years, 2017 and 2018, of pretty much record fundraising, back to the sorts of levels that we had prior to the financial crisis. And I always regard fundraising numbers as being the most interesting indicator of the health of the industry, because that tells you what it is that investors think about private equity's potential capacity for the future. The funds that are being raised in 2017, 2018, again now in 2019, are the funds that will be invested over the next 5, 6, 7 years. And so if fundraising is high, that tells you something about just how optimistic investors are about this asset class and how positively they view private equity and venture capital in Europe. So if we look at what's happened to fundraising over the course of the last few years, I think we can certainly say that private equity is operating in a time of change. The bounce back since 2009, 10, 11 in terms of fundraising is not just evidence of change, but I think evidence of transformation. But what about, in other respects, in other regards, can we say that private equity has really been changing over the course of the last few years? And there, frankly, I think the evidence is not quite so profound. If you look at where it is that are the centres of private equity, it's really not changed very much over the course of the last 5 years. The UK, London in particular, is still the biggest centre for private equity fundraising and fund management. Of course, not all of this capital that's raised by UK-based managers will be invested in the UK, far from it. But it's still the case that the UK is the dominant centre for private equity. And there's a lot of stability in terms of which parts of Europe are active in private equity. It's a similar story, really, if we look at the different segments that make up the private equity industry. It's still predominantly a buyout industry. It's true that over the course of the last year or two, the resurgence, the renaissance of European venture capital has given VC a slightly increased market share of total fundraising. But when we talk about the industry in Europe, we're still predominantly talking about it being a buyout industry. What about where the funds are coming from? What about the providers of the capital that fund managers are putting to work? Well, there too, I think there's a striking amount of consistency. If we look across private equity as a whole, we see that it's still pension funds that are far and away the principal providers of capital for this sector. And all of these lines, I think, show a remarkable degree of consistency. They're pretty flat curves. That's, I think, a sign of the success that private equity fund managers have with persuading investors to re-up from fund to fund. But it's remarkable, I think, that as the volumes have grown dramatically, it's still basically been the same types of investors that have been putting money to work in this asset class in the same proportions. A little bit more volatility if we look at venture capital, but still a remarkable degree of consistency. And remarkable, I think, that despite all of the success that we've had, it's still the government, it's still the taxpayer that's one of the largest investors in venture capital as an asset class. Not in 2018 the largest. It's nice to see that other private forms of capital have now taken that top spot. But again, I think if you look at the VC sector, what most strikes one, I think, in looking at these data points is not change, but is actually consistency. And it's pretty much the same story if we look at where, by geography, the funds are coming from that come into our industry. This slide and the one that follows breaks down in Europe where it is that fundraising takes place. And you can see, again, a remarkable degree of consistency. For venture capital, the vast majority of fundraising is entirely domestic. That's hardly changed, really. The share that's entirely domestic hasn't changed in more than a decade. The share that is cross-border European hasn't really changed for the smaller funds. And it's not that different a story if you look at the larger funds, the funds that are in excess of 500 million euros. It's still basically the same sources of fundraising today as there were 10 years ago. A little bit of an increase in cross-border fundraising, but nothing that you would describe as transformational or that you would describe as in any way revolutionary. So despite the fact that we've had many years of activity by policymakers to try and promote more equity investing, to try and encourage more investment into venture capital and private equity, despite the efforts, frankly, of organizations like Invest Europe and BVK and others to get out there into the world and sell European private equity and venture capital to global investors, actually what we see is still a remarkable degree of consistency in how it is that this industry is operating. If you go back to when I joined EVCA, as it then was in 2013, and when I was still working for the UK government, we were expecting, by virtue of the arrival of AIFMD, a kind of revolution in private equity, that there would be really dramatic changes driven by regulation in how this industry functions, how this industry operates. Now, I'm sure at the level of individual funds, and for those of you that are from the legal profession, you have seen significant change. You have seen an enormous amount of additional paperwork that has to be produced. You've seen significant new reporting requirements, policies having to be documented and put in place. But the overall conclusion, I think, that one has to reach if one looks at the AIFMD is that it's not really had that much of an effect. And that's backed up not only by a piece of research that Invest Europe commissioned from a firm called Europe Economics, it's also backed up by the research that the European Commission itself had done by KPMG. Both of these studies, which have involved lengthy discussions with GPs and LPs, qualitative and quantitative analysis, both of these studies have concluded that actually, despite imposing some cost on the industry, actually AIFMD has not had that much of an effect on the industry. So it's been thriving, but there hasn't actually been that much change in the underlying structures and the underlying ways in which the industry functions. What then of the future? If the last 5 years, 10 years have seen, yes, a resurgence, a revitalization of the industry in terms of fundraising, but consistency in many other respects, can we expect the same thing for the future? You don't have to turn on the television, pick up a newspaper without seeing doom-laden stories about protectionism, about deglobalization, about the resurgence of of economic nationalism. And there are clearly reasons to be concerned about that. At the global level, barely a day goes by without the US administration threatening a trade war with somebody or other. And here in Europe, we've got lots of reasons to be cautious that the sort of environment in which private equity has been thriving for the last 5 or 10 years might be under threat. Brexit clearly is one threat to that. But across many European member states, you've seen the growth in support for parties that question the European project, question the globalization that is really at the heart of the financial services industry and at the heart of the private equity industry. But I don't think that we have too much reason to be concerned in European private equity. The most recent and most visible opportunity to test whether this economic nationalist, this protectionist agenda is taking hold came with the European Parliament elections. And while it's true that the two main political groups, the centre-right EPP and the centre-left socialists, dropped back a little bit, and there were some gains for parties from the more extreme ends of the political spectrum, the reality is that we still have a European Parliament today that can command a very comfortable, very healthy majority of MEPs that are pro-EU, pro the European project, and supportive of the kind of open market activity that supports our industry. And we've seen just in the course of the last week with the allocation of top jobs in Brussels, the European Commission President, ECB, etc., just how business as usual things at the EU level seem to be. Indeed, one might argue, if one looks at the way that process has played out and the way the horse trading has developed, that it's perhaps been a little bit too business as usual in the way those top jobs have been allocated. But at the EU level at least, and I recognise that in individual countries there's some very specific developments, but at the EU level, at least, I think we can be reasonably confident that the next 5 years of political leadership will actually look pretty similar to the 5 years that have gone before. That's not to say that everything will necessarily be a bed of roses. That's not to say that everything will necessarily be pain-free, because the next 5 years, I think it's safe to assume, will be a 5 years in which we no longer have UK politicians, UK officials involved in EU decision-making. And any of you that were around in 2008, 2009, 10, when the AIFMD was being created, will remember that the sorts of positive provisions that AIFMD contains, particularly around cross-border activity and third country manager access, are really only there because of the political weight that UK politicians put behind the idea that Europe should not close itself off, that the European market should continue to be open. So while at the macro level in the European Parliament and in the European Commission, and indeed in the ECB, we will have politicians that I think are committed to the sort of model that we've all been used to. At the granular level, at the more micro level, I think there are some reasons to have some concerns. If you look at the sorts of issues that we will face with AIFMD, there's reason to believe, I think, that AIFMD 2, when it gets proposed probably next year, may well contain some things that the industry needs to pay particular attention to. I'm convinced, for example, that with the large growth in support for the Green Party, that we'll see sustainable finance and ESG hardwired into future legislation that impacts on the asset management industry. I'm convinced that there will be further pressure on remuneration models. We've seen it for the banks, we've seen it for the traditional asset managers. There's no reason to believe that that won't also come along for alternative asset managers. And I think on leverage as well. We know that politicians and supervisors who have concerns about where we are in the economic cycle will start to get interested in the ways in which this industry has been changing some of its behaviours in things like subscription credit facilities, fund use of leverage. So while the big picture story, I think, is one that shouldn't concern us too much, I don't think we should fear that change is coming in any dramatic way at the European level. There are sufficiently significant changes in the composition of those people that will be making policy that directly impacts on private equity for us to remain alert and for us to remain vigilant. And it won't just be AIFMD. We don't yet know who will be the next European Commissioner for Tax or the next European Commissioner for Financial Services. But you don't need to spend very long talking to European Commission officials to realize that across many areas of policy, from tax through financial stability, through to broader investor protection, that there is an agenda ready and waiting to be put forward. And so, if nothing else, what we need to do over the course of the next 5 years, as I think we've done very successfully over the course of the last decade, is remain united as an industry. The loss of the UK from the corridors of power in Brussels will have an impact. It will have an effect on how our industry's voice can be heard. But we are not powerless to do something about that. And whether that be through supporting the BVK, whether that be through supporting Invest Europe, preferably both, or through simply getting involved in your firm in thinking about how you can have a voice in these sorts of regulatory debates, I would encourage you to do so. Because while the overall message I want to leave you with is that this industry will continue to thrive in a time of change, some of those changes that are coming are ones that we do have to pay attention to and do have to devote some time and effort to trying to shape and to influence. Thank you very much.